So I would like to just introduce this session, and this session, we still live within the separate entity approach. We've seen issues around services, intangibles, and now we are moving into a highly fascinating topic, which is going to be on intra-group financing. And I would like to hand over the floor to Professor Maisto, who's going to be the chair of the session. And Professor Maisto, the floor is all yours.
Thank you very much, Vikram, and good afternoon. We indeed addressing today intergroup financing transaction after the series of TP topics that have been already discussed. If we move to the next slide, please. Well, here we have a panel, Alessandro Bicchieri from Enel, Anton Fortunato Corneli from EY, Andrea Granger from Swiss Re, and Antonio Russo for Baker McKenzie. Let me tell you how we have organized the panel discussion. We basically have identified the three topics which have to do with intergroup financing and transfer pricing. Topic number one is the challenges for MNE that has to do with primarily, but not exclusively, with the 2020 OECD report on financial transactions. A second topic that we have identified is intergroup financing and COVID-19. And the third topic is one which several MNE do face, is the regime applicable to cash pooling arrangements. We do have a leading presentation for each of the subjects, and then we open a discussion, and we have time allocated for Q&A. So we may kick off with the first subject, the main challenges for MNE, and here we have the experience of Alessandro Bicchieri from Enel. Alessandro, please.
Thank you, Guglielmo. Let me start, if we go, yeah, perfect. Let me spend 1 minute on the environment in which our group operates and what is our internal model to deal with finance in our business operation worldwide. As you can see, we manage our financial decisions in a quite centralized way. We have the treasury and financial center that goes to the market using all the tools available. Now, such as classically bonds, loans, commercial paper, and derivatives. And of course, when it goes to the market, it is assisted by a guarantee from the holding. And in terms of function performed, our center is a full-fledged treasury center. So here you see, cash management, financial planning, raising funds, manage the overall funding position, monitor interest rate risk. So this is the general environment. And in the next slide, I tried, let's say, also to give a general framework in which I will comment on main challenges. What are the key principles that are driving our TP approach to financial transaction? One is quite obvious, of course. Arm's length is the polar star, and so what we decided even if in some countries, as you know, there are safe harbors, we decide to apply consistently for all transactions, for all jurisdictions, the TP policy following the arm's length principle. With respect to group funding, our, let's say, primary and core funding is done in the bond market, and this is, let's say, introducing some issues because, of course, those bonds have sometimes very long maturity, 10, 15, 20 years, which are, let's say, not replicable easily into the intercompany loans. And another policy that we are following is that in general, we are not having any back-to-back transaction and financing. So when a company asks for a specific need or financing, we don't have a corresponding financing directly into the market, but it is financed on a portfolio basis. One other interesting information is that up to now, we were following a very, let's say, strict separate entity approach in pricing the intercompany transactions. So we were considering each subsidiary purely using the credit rating as a pure standalone basis. And of course, we are transitioning, and we will go a little deeper later. We are transitioning in a new model to take into account the new Chapter 10 OECD guideline, considering the group membership and the passive association, concept. The last important point that I wanted to highlight is that the debt to equity composition is basically made at holding level. So it's not the Treasury Center that decide that. And of course, this is a more strategic and business decision driven by, let's say, the specific business needs, considering the relative positioning in the business cycle, the capital intensity, and so on. So having said that, and going finally to what are the main challenges that we are facing, also in connection with the guidance issued in March 2020, after, as you know, a long and painful debate, I would say that there are three main areas on which we see criticalities. One is for sure debt recharacterization, particularly the concept of debt capacity, which is defined as you know, the ability to the recipient of the funds to obtain loans from an external financial institution, independent one, a bank, for example, and the ability to repay the loan based on terms and conditions established in the contract. Why is important? We are experiencing more and more discussion with tax authorities, for example, in US, that are challenging the nature of the flows, arguing that all or part of the inflows is in reality an equity contribution, and not recognizing the deductibility of the interest paid, and treating the outflows as dividends instead than interest. One important ramification here of the debt capacity of the subsidiary is in the alternative scenario in which you do not finance directly the company, but you provide a guarantee so that the subsidiary can borrow in the local market. We also, in this case, dealt with debt capacity discussion because some tax authorities are challenging the deductibility of the interest paid to the financial institution on the basis that in reality, the loan is granted to the holding that was giving the guarantee and not to the subsidiary. On the basis, on the fact that the guarantee is not just, let's say, giving a better conditions, a better, let's say, interest rate, but it's also in reality giving the possibility to go to the market, which would be impossible for the subsidiary without the guarantee. So this is a pretty interesting and challenging discussion we are facing from time to time. Second concept, which is really challenging for us, is the one of options realistically available, both for the lender and for the borrower. And I'd like here to highlight that this concept is usually taken into account when you conclude the transaction. but in reality has to be monitored during the entire life of the financial transaction, meaning that if, for example, the macroeconomic conditions change significantly, you have always to ask yourself what an independent company in your country, in your business would do. An example here that in which we are facing a discussion again with tax authorities. Sometimes they are challenging in some situation that when there was a specific good window of interest rates very low going down with respect to the past, and some competitors in the market of the subsidiary were renegotiating with the bank's terms and conditions, then the tax authorities are saying basically, well, you should do the same in an intercompany situation. And sometimes you are in trouble because in your intercompany contracts, maybe you not have the right clauses for breakage fee or situation like that, which is, let's say, a very, to me, it's really an interesting thing to look at. Going quickly, last challenge is clearly, again, the credit rating setup and definition. Of course, credit rating is key in pricing the instruments. As everybody knows, the OECD guidance for the first time gives a clear role of group membership, and also among the options, it is suggested the idea of using the techniques that credit rating agencies are using to define the credit rating in a group. And here the challenge comes from the fact that the credit rating models rely, as you know, both on quantitative and qualitative factors. And clearly the tendency is that let's say, stick to the quantitative information, but and open sometimes a discussion on other qualitative consideration that you might imply in your models of rating. And this is again something that I think we will face more and more, and we already started to have. So I try to go very quickly and using my 10 minutes in defining the main challenges. So Guglielmo, I leave you the floor.
Thank you, Alessandro. I have a couple of questions, but I should let Antonio first and Andrea and Anton Fortunato to comment. So Antonio, please.
Thank you, Guglielmo. And Alessandro, thank you for your presentation. I think it was quite clear and to the point. I do recognize many of the challenges that clients that I work with face. So a lot of similarities. I wanted to start from your first point on the role of Treasury. I think this is quite a key point because corporate finance, Treasury, the tax department, the business, of course, are all stakeholders, important stakeholders in defining the transfer pricing policy for intercompany financing. However, what often we observe is that taxing authorities not necessarily sufficiently recognize the role of Treasury. And that may come from the fact that in the past, maybe certain Treasury functions, which were really cost centers, were emphasized as profit centers. And again, that is certainly not something that we can point fingers to at the tax authorities, but at the same time, there might have been lack of understanding on the side of tax authorities as to the role of Treasury proper. So what we find, generally speaking, is that that part is an educational piece that is very critical in the early stages when you set up your internal policy, when you set up your intercompany financing policy, making sure that you clearly explain the key stakeholders, the role of Treasury, the role of corporate finance, the interaction between Treasury, corporate finance, and the business. And in my view, oftentimes what is not done, which should be taken into account, is combining the view of the supply side, meaning who has access to funding, who has access to resources, whether these are internal funding or external financial resources, and the demand side. So why funding is needed, why funding is necessary. And that is where often you find the right balance in defending your policy via the tax authorities, giving sufficient relevance not only to the story of the Treasury, but also to the story of the borrowers. So why are borrowers in need of funding? Why, in fact, it is critical for them to access funding, and why, in fact, accessing funding internally provides superior options, going back to your point of options realistically available, than options offered by the market. One point on Treasury, which I find particularly useful in the new guidance, is that if you remember, in the original draft, when it was published by the OECD, the role of Treasury was really depicted as a cost center. There were not many options. There was just one flavor. Treasury is a cost center. And we all know that that is not necessarily the case. And actually, more often than not, Treasury is a transactional center, and in some cases, a real profit center. In your case, you talked about taking proprietary positions, for instance. It's clear that your Treasury is not just a cost center. So to me, I think that was a problem. And now in the new guidance, what we find in Chapter 10, the more nuanced position of the OECD is actually welcome news, because they do accommodate a bigger spectrum of options in terms of how a Treasury center can be characterized. So that was my first comment. Now, in terms of challenges, and going back to the other point that you were making, sources of funding, that is typically a big challenge in terms of correctly pricing the external cost of funding and translating that into a point of reference for internal funding. And so, I mean, I'm not saying that this is a failure of multinationals. It's just a complex exercise that is often underestimated. What is the real external cost of funding? How do we look at cost of funding? Because sources of funding may be different, and translating all of that into an internal policy, or at least in a comparator for internal policy, is not a simple exercise. And so to me, that is indeed a big challenge that multinationals face. Now, another point that you touched upon is credit rating. And again, in terms of establishing intercompany financing policies, of course, that is a key starting point, measuring risk, measuring credit risk. But we know that credit risk is not the only risk. Credit risk is incorporating or embedding a number of other considerations, but yet credit risk is the starting point in order to correctly price intercompany transactions. Now, on credit risk pricing, we do see, again, in the guidance, more flexibility on the side of the OECD, but also more flexibility on the side of taxing authorities. It is true that now the notion of implicit support is mainstream in the guidelines. It is also true that already in the previous version of the guidelines, so the one published in 2017, in absence of Chapter 10, we had examples that were pointing exactly to this direction, because the examples that we had in Chapter 1, in particular the examples on guarantees, were really pointing on the use of the notion of implicit support. Now, yes, it's a big change, is an epochal change in the way we have looked at intercompany financing compared to what we were doing maybe 15 years ago, what we were doing 20 years ago in pricing transactions. At the same time, I do believe that as much as it proves a challenge, it also gives some opportunities in the sense that I think it can be implemented in a simplified manner. I just want to make reference, for instance, to what we in practice often do, using qualitative type of scoring assessments, using, for instance, Moody's white papers on a sector basis and translate that in quantification for credit rating. I think that's a step forward because, I mean, we need to be honest, relying only on black box type of approaches, such as Moody's KMV or such as credit score of Standard & Poor, more often than not doesn't do justice really at the complexity of the situation and the complexity of the transaction that we are trying to price. So I find this also potentially moving in the right direction, at the same time knowing that this can be used instrumentally by taxing authorities to, in fact, take positions that we not necessarily agree with. On the capital structure, going back to another point that you raised, that is a critical aspect in my view. And in fact, here, if you were to ask me this question 10 years ago or 15 years ago, I would have answered to you that the capital structure, how to structure capital, is an arm's length question, is a question that belongs to the sphere of the arm's length principle. And as a matter of fact, I'm convinced that we could avoid adopting thin capitalization approaches and only use the arm's length standard also to look at the capital structure. At the same time, we also know that the environment, and that is where the challenges are coming from, show that taxing authorities don't want to lose the two options to attack capital structures using thin cap and using the arm's length standard. So we were seriously disappointed some years ago when Australia published for the first time the guidance that allowed tax authorities to use both, and in fact compress taxpayers between two boundaries which were impossible to match. Unfortunately, that is what we find confirmed in the guidelines, where in fact they allow for the possibility to use simultaneously both thin cap rules as well as the arm's length standard to compress the position taken by taxpayers on capital structures. So that's the reality, but we knew that because also in the BEPS project, that was the sense of direction. So to me, again, big challenge. Practically speaking, the way it is addressed, as you certainly know, is you clearly look at conditions of the transactions, and I translate that into looking very closely at covenants when you use external comparators, when you use external comparables, not only looking at the main conditions of the transaction, but also looking very closely at the fundamentals, the financial fundamentals, the covenants used in the contracts, because that will help in determining, using ratios, whether a capital structure is supportable or not. So these were my comments building on what you were saying.
Thank you. Before I move on to the other panelists, as you mentioned the rating, there is a question that we can pick up from the audience, which says that according to the soft harbor in the OECD at paragraph 10.15 of chapter 10, how the group credit rating could be applicable to bank groups, which element could be evaluated as to increase the subs rating in a bank group. I don't know, Antonio, if you want to reply on that, as you may have more experience on banking, but although I think that both Andrea, Antonio Fortunato and Alessandro may like to comment on that.
If somebody else wants to comment, please go ahead. I will ponder about what to say and how to respond.
Okay, we can then have comments on Alessandro's presentation by Andrea and Antonio Fortunato.
Questions, Guglielmo? I actually had one on the approach that your group has decided to take in relation to how to weigh the differences in rating between the parent company or the highest rated entity and the other subsidiaries. You mentioned earlier that there are qualitative parameters as well in the methodology proposed by the rating agencies. Since there appears to be in Chapter 10 sort of a bias of tax authorities towards flattening credit risk across groups, they don't want to see a lot of arbitrage going on within the groups. Have you somehow used that bias to use the flexibility of qualitative parameters to sort of enhance to the extent possible the rating of subsidiaries?
Well, it's really a good question in the sense that We are, of course, we are trying to do that. It's clear that the guidance is flattering everything. So it's, we are more in an environment in which the spreads that you can apply are really going thinner and thinner. But frankly speaking, so we are trying to use some qualitative adjustment, but we are really struggling to do it. So it's really a tough point.
Andrea, do you have any comment from your side?
Yeah, I have a question actually for Alessandro. So when we've been trying to implement the new guidance from the OECD in our group, we've noticed, like on a practical level, that we end up doing a lot more documentation and a lot more thinking about the economics of the transactions and just trying to explain it in a simple way maybe than we did before. I was wondering, from your point of view, what's the most practical change that you've made in your approach?
Well, we were introducing already some years ago a system, of course, a process and also a tool in which we force both the borrower and the lender to put in a TP form, which is pretty guided, let's say, their point of view, no? both parties. And I have to say, and on this I agree completely with Antonio, that the focus that we were in general giving to describe the transaction, especially the needs of the borrower and the reason why, and the structure, why this structure of the transaction and not another, was not so let's say detailed. So what we are really changing is not the structure of the documentation. It was already there, but the attention and the quality on this kind of analysis, because I agree with Antonio 100% that the borrower side was a bit neglected in the past, and it's really key in defending the positions when you discuss with tax authorities.
I had also, thank you, Alessandro. I also have a question. You mentioned recharacterization, debt recharacterization, and just wonder whether you had any experience in terms of challenge which led to an MAP, if not arbitration, because what it appeared to be a controversial aspect in some countries is which rules you may use in order to recharacterize whether you can indeed use transfer pricing provisions or anti-abuse provision, in which case in some countries you are denied or you may be denied access to competent authority. And I think there is one court decision recently in 2020, I think it's a Finnish court decision, which precisely denies the application of transfer pricing rules to recharacterization of debt into equity. And so I just wonder whether you have or any other panelists experienced MAP access on debt recharacterization, experiencing some issues.
No, we don't have, let's say, a specific situation in which we went into MAP or discussion like that. What we try to do, and the example that I was mentioning before, what we try to do is to discuss in advance, formally or informally, with the tax authorities, and so the discussion was mentioning, I was mentioning where exactly in structuring the transaction and in presenting in advance when we have some doubts. So we didn't go yet into, let's say, hard litigation. So no experience from that side, on this side.
Thank you. Well, if there are no other questions or comments, then I believe we can move to the next segment of our panel, which is COVID-19. And COVID-19 has been discussed in the previous segments, but not in relation to financial transactions. So that's the reason for which we have included the subject into our debate. And so I give the floor to Anton Fortunato, and then we can continue with our discussion.
So what is the relevance of a pandemic on the transfer pricing of financial transactions? Definitely, COVID-19 had a huge impact on some of the risks that are currently normally priced in a financial transaction. So let's look at what happens, generally speaking, in most credit pricing policies. Generally, volatility, they have to deal normally with volatility. So financial players are used to volatility, are used in the parameters in the market of pricing of various risks are always volatile and react quite steeply to the most various shocks in the economy. So the context of COVID-19 is that we had not yet, of course, this is a sort of a Euro area perspective. I'm afraid there will be listeners from other areas in the group, in the world, but this is just meaningful of how a Westerner in Europe would look at things in the market. We're still recovering from the great crisis of this century. So the 2009 financial crisis, the 2012 sovereign debt crisis, and ongoing recessions in various market sectors. So an economy which in various jurisdictions, it was still recovering and struggling to strengthen itself. And the market, financial market, was always very sensitive to any potential variation of future profitability of market players. The first lockdowns in April, in March, actually have determined a shortage of demand and the halting of production, and then really unknown duration, extension, potential ramification in market sectors, a lot of uncertainty. As well with the lockdowns came cash shortage. So most of the businesses had less revenue, had longer cash in on receivables, some losses on receivables as well. And along with that, there was an increased public spending to support businesses, to support people to make it through the pandemic. And this has caused a very broad increase of credit risk and public debt default risk. So a lot of fear from the banks in lending to businesses, in buying public debt, and along with a fear of not being able to predict properly credit risk, because the modeling by most market players does not have a proper modeling of a pandemic effect on credit risk. That caused a shrinking in the lending by banks, as well as a potential risk of huge losses, non-performing loans, a possibility that capital would not be sufficient for banks. So banks have stood still, have lent very little, and this has caused a very high illiquidity in the market of lending. And in the secondary market of lending, we have experienced in the euro area a steep increase of credit spreads. So we have some statistics from the ECB showing that non-investment grade bonds increased on average in March of this year, on average 500 basis points in credit spreads. And we reached almost 200 basis points on non-investment grade debt, so better quality debt in the market. However, how meaningful is secondary market when it's clearly liquid, when most of the players are trying to sell, very few are buying? So is secondary market a clear reference or benchmark for businesses or for tax authorities for pricing debt? Well, normally it is. It is so much that banks monitor their secondary debt trading of their senior debt to build their curve cost of funds and price that cost of funds, because they have to for regulatory purposes, in the loans that they disperse to the market. But at a time in which there's a big shock on credit risk pricing, are they still meaningful? Possibly not. Possibly not, because there were still businesses and market players lending. There was lending below secondary market rates. Typically, for example, Andrea, there are investment managers in the insurance and reinsurance industry that look at long-term investments, long-term yields, not just for trading. And they would disperse a loan to hold it until redemption. And if they know that a counterparty is strong, they would still lend, not looking at the secondary market pricing. Secondary market pricing is monitored mainly by banks that need to take liquid positions that they can dispose of, so they're not locked in with those assets. So this great illiquidity has caused steep increase in market rates of debt. So what happens if we do apply the new framework for Chapter 10 and let's say the additional comments that the OECD have provided on the interpretation of accurate delineation for financial transactions, that if a business was to issue debt during such a big crisis, would long-term, for example, a borrowing be recognized, or should it be recognized by tax authorities? So issuing debt into a company on a 10-year term at very high rates, is it justified? Would a rational market player do that with an independent counterparty? Possibly not. Maybe they would use some short-term debt, which is less affected by the increase in the market pricing, make it through the crisis, and then maybe issue long-term, unless they thought that it was getting worse. So they would want to take advantage of the pricing before it worsens. Also, accurate delineation plays a very important role here, because according to the OECD guidelines, one could claim that any new collateral, any available collateral should be used when trying to issue debt when credit spreads are very high. So clearly, we see a lot of transactions in our practices in which intercompany loans are issued without really looking into, is there a possibility for a borrower to decrease the cost of funds by providing some kind of additional security on the loan? Okay, this is a time in which credit spreads and pricing is so high that there would possibly be a lot of attention from the tax authorities to make sure that the cost has been reduced to the extent possible based on the new guidance from the OECD. Also, very interestingly, there are references in the guidance on how would normally borrowers behave in the market, and of course, and lenders, I'm sorry. So they would definitely use some covenants. So a bank, for example, would ensure that the same sort of prospective profitability of a borrower and equity to debt level that defines the risk of investing into a certain borrower would stay over time. So covenants, just like maintenance covenants, monitoring the profitability and the capitalization of the borrower are typical practice of independent lending in the market. So if, for example, during a pandemic, a borrower comes under stress of cash, and maybe its prospective profitability goes down, that becomes sort of a stressful borrower. And tax authorities could claim that had that borrower agreed terms on an arm's length basis, there would be a covenant there, which would make that loan accelerate, because suddenly the borrower is not able to service that loan anymore. and doesn't provide the sufficient guarantees that we'll be able to redeem that at term. So if that happens, that puts us in a situation in which tax authorities could claim that a loan has accelerated and needs to be renegotiated. So if you do have to renegotiate, of course, the first thing that you look at, would this entire amount of debt be justified currently based on the capacity of the borrower, and possibly need to recharacterize some of that as equity because the borrower is not able to service the entire amount of the loan going forward. But that looks a lot like something an independent lender would do in restructuring a loan. So I have lent to a borrower, the borrower faces some difficulties. We have to ensure that we allow the borrower to make it through the difficulties. So quite often we see banks restructuring debt and converting some of the capital amount of it into equity, for example, and maybe sort of negotiating better conditions for rates. So is this something that, by applying the guidance from the OECD, tax authorities could claim? So this is sort of clearly a situation in which accurate delineation in financial transactions can be taken to a certain extent to, to possibly even claim that debt needs to be restructured, even though it's been entered into even before the guidance from the OECD about accurate delineation or accurate delineation in a financial transaction. If we have additional potential consequences from interaction of COVID-19 with financial transactions, for example, there are commentators currently wondering whether force majeure should be considered in financial transactions. I don't think so. Typically, force majeure is one of the elements that is weighed in the risk of lending. So when a lender lends to a borrower, it accounts for the fact that the borrower could go bust just because the economy that's hosting that enterprise goes bust, or the state that's seizing the asset of a business. So definitely it's financial transactions do include weighing of the possibility of the risk of disaster even. So force majeure, I don't see how it could be used in a financial transaction. Clearly, also in financial transaction value chains, there are often functions which are considered to be of adding lower value to a financial transaction, and are currently remunerated with a cost plus transactional net margin method. And clearly, the guidance from back in December from the OECD would definitely apply to those functions. Again, we do have consequences from COVID-19 in relation to the fact that cash pooling, cash concentration structures are becoming very, very important because there is a lot of need of cash. So these probably come under stress because businesses are taking a lot from cash poolings, and which leads into the next topic. Last, there is clearly a risk that the current displacement of current functions in a business or key people functions in a non-financial business could cause some alterations to the arm's length allocation of profits, in particular in relation to the deployment of profit splitting. So when resources and key resources of a business are located in countries which do not really match with either the headquarters or branches of a business, and maybe they work out of home offices, as per the OECD definition, also in the recent guidance, maybe there is a risk that the presence of these people in other jurisdictions could attract some profit attribution. I think I didn't monitor my time precisely. Guglielmo, have I gone beyond?
No problem. I think if you have one more point to raise, but we have time. Otherwise, we can take it.
Yes, maybe just one point that Alessandro briefly mentioned before. the let's say the skyrocketing of market rates has caused also a lock-in effect in relation to the transfer of financial instruments, for example, within a group, assets, loans, the early redemption of funding, for example, since renegotiating or interrupting a lending in advance does, generally speaking, imply a breakage costs. So having to assess the value of a financial instruments at current rates, reassess the value at current rates, that typically determines, based on financial transaction market practice, so it should be accounted for under accurate delineation. It does generate friction in terms of differences between the original rates and the current market rates.
Thank you. Thank you. And very interesting issues you have raised. I have one question which has to do with the practice of a few countries to deliver, to grant state guarantees to parent companies, which may make borrowing cheaper. And the point is whether the benefit of such state guarantees, namely the saving on the borrowing when the parent is lending to subsidiaries, should be shifted as well, or whether the benefit should remain in the hands of the parent. Is an issue which for COVID-19 goes beyond financing, because we had that on other measures, and the issues being debated in the relation between a manufacturer and a distributor, or a principal and a contract manufacturer. So I wonder whether how you would address that particular aspect.
It's a very interesting question, Guglielmo. I think that the recent guidance in Chapter 10 has shifted a lot of the intention. I agree actually with the OECD towards the actual market pricing, a dual-sided analysis, because pricing based on cost of funding and remuneration of incremental risk, which was a market practice in several, in particular in industrial intercompany lending, in non-financial services, could lead to the pricing of loans that exceed an arm's length rate. Okay, go beyond just because the headquarters or the lending entity is not efficient enough in order to raise funds in a competitive manner compared to market standards. So I think that the only way to enable that natural transmission of some of the saving of the parent company into the subsidiaries, well, unless of course the subsidiaries are located abroad, which was not the first intention possibly of the state granting that reduced rate or guarantee in the first place, would be to price the lending based on the cost of funding. Okay, and if the cost of funding is actually fairly aligned to market standards, which is possibly the case right now, making available cheaper funding could generate, however, a risk, because it basically would be a way to subsidize a foreign business based on some subsidy received by the headquarters. So I think that there is a possibility to justify, but clearly it's not free of risk.
If I may, Guglielmo, because this is a great question, and I agree with Anton Fortunato and his analysis. But if we apply by analogy the position that certain governments have already taken in terms of how subsidies should play in the transfer pricing policy, subsidies related to COVID, and how they cannot be absorbed by the transfer pricing policy. So in other words, if you have a subsidiary which is in requirement of support, and that support is given by the local government, we have seen governments already stating very clearly that that subsidy cannot flow into the transfer pricing policy. So it has to be taken below the line. Then by analogy, in this top-down example that you have proposed, I would argue that you should keep your arm's length pricing on the loan, and the advantage given at the headquarters should not be reverberated down at the level of the subsidiary. So I think that is consistent with your view, Anton Fortunato, I guess.
I would like to add a comment in relation to that, which is quite amusing. It's fun. I enjoy transfer pricing. We have been facing in financial services for years now with some kind of a struggle. One of the sources of funding of banks is currently ECB funding, which is typically a collateralized funding. So you lend securities to the ECB and you give security, you lend security, you take cash at negative rates. So, and that the purpose of that is transfer that benefit into the dispersing of cheaper loans to the economy, okay? Banks do currently account for that source of funding, but it's clearly a subsidy. It's monetary politic subsidy, but it is not sterilized, as you advised correctly. So maybe COVID-19 may be exceptional, but we are already living with some kind of noise in the funding of banks, which creates some discomfort when we have to discuss funding policies as well.
On your point, Antonio, I agree about the not shifting, but perhaps, and I don't want to focus on this question that I raised, but perhaps one could make a distinction between subsidy and subsidy, because if the subsidy is in return for commitments which have to do with the situation in the country in which the government is granting the subsidy, like maintaining manpower and employment, then is perhaps different from situation where there is no such, let's say, a relationship between the subsidy on the one hand and commitments which perhaps may have to do with the situation in the subsidiaries and therefore may have a reason for, let's say, a different approach. But I take the view that by analogy, one on the safer side would apply the way the OECD indicated, or both countries indicated. This being said, maybe Alessandro, and first I think Antonio, you have other comments that you want to make, I think.
Yeah, I don't want to take too much time because we still have one important topic to address, but maybe a couple of comments on what Anton Fortunato was saying. I think a very interesting analysis. One general observation is that as opposed to the financial crisis of 2008-2010, which was a financial crisis, a crisis that was originated in the financial markets in the first place, of course, with links to the real economy, subprime mortgages in the US. But that was a financial crisis. This crisis is fundamentally a supply crisis first, and then a demand crisis, because the supply shock converted into a demand shock, which then converted into another supply shock. And beyond that, what I observe is that there are more permanent changes that have been introduced in operating models of companies. And I'm not talking about financial institutions, I'm talking about the industrials. Companies that had to face the reality of not being able to deliver simply because they didn't have digital interfaces, just to give you one concrete example. So what I do see is that this economic crisis has different fundamentals and will probably have longer term impacts in the way companies fund themselves and for what they are looking at financial markets, what the purposes of funding is. So I think we will see longer lasting effects of these crises. And maybe a couple of other points picking up on Anton Fortunato was saying. Clearly, we will see similar impacts in terms of availability of benchmarks in external financial transactions. So similar to conditions during the subprime mortgage crisis, we will see further restrictions on liquidity and lack of interest rates benchmarks at certain interest rates or at certain credit ratings. However, as we did observe back then, and I did a bit of an experimental example at that time, trying to counter the position that some tax authorities were saying that below investment grade, you couldn't find transactions. What we did observe in those years is that, in fact, a vast majority of transactions were happening below investment grade when you were looking at the syndicate loan market. And I think this is going to happen again because access to liquidity and conditions, economic conditions varying, I think will create a market there. And then one additional point is I do believe that we will see increased use of parental guarantees, either standby letters or keep well agreements. So that is given a glimpse of what we may want to discuss later. But I think that is something that we see in practice, and this will be here to stay for quite some time.
Thank you, Alessandro and Andrea. You want to comment on that?
Just a very quick comment. Just saying that we really had a couple of examples in March and April in which we had to refinance, some subsidiary had to refinance quite important and big lines. Of course, he was planned before, but nobody was expecting that in March we would be in a situation of having such a kind of rates. And so we were really asking ourselves what an independent company would do. And since usually having long-term investments, those kind of companies, usually they commit for a fixed rate long-term. What we decided to do is to shorten a bit instead of 10 years, putting 5 years instead of fixed rate with a breakage fee on top, just going with a variable rate that gives you more flexibility in case you want to, let's say, restructure in a later stage, looking at the different market conditions. So the example you made, it's really happening in the reality.
Andrea?
Yeah, I think that what Alessandro, you just said is an interesting idea of using floating rates instead of fixed rates. And I was going to ask Fortunato, what do you think of, what are your strategies to use when you're lacking benchmarks? I mean, that's something we deal with in the insurance industry quite a lot. And, you know, one approach we take is looking at a longer period, for example, and trying to look at things over time rather than at a certain instance in time. What do you think that would work here, or is that?
Typically what we do when we're lacking benchmarks for rates, for example, we use the fundamentals like banks do. Problem is that banks also have a fairly good developed modeling of credit risk, and rating agencies as well do have that modeling of credit risk in certain subsectors. And back in April, no one had anything that could consider the impact of COVID. Nobody knew the exact consequences, the time that COVID could last, and what sectors it could reach. What would be the transmission of the shock? Okay, exactly. So really, I guess we could use some help from the OECD on that point, meaning that there are definitely transactions that have taken place in the market, but they're clearly OTC. They're confidential transactions. When we need help and we deal with banks, we usually speak with the syndicate teams in London. So London is the center of syndicate in the world for OTC dealing. So they know exactly what the market is pricing loan at a current stage. But that's again, getting back to the secondary market for OTC, non-securitized debt. Okay, so possibly they were not doing any deals in those, back in March and April. Now the market is a bit better because let's say there is a way out of COVID. Somebody sees a way out of COVID, and we know we have a better understanding of the consequences. But clearly, Andrea, you hit a very sensitive spot. We are lacking very strong comparables, benchmarks. Yes.
Thank you. So we may now move to the last segment, and perhaps we may have even more time for Q&A on other issues. And the third segment, as anticipated, is cash pooling. And so Andrea, you may like to present the stimulating issues on cash pooling, and then we can open the discussion. Hello?
I think we dropped, we lost her.
Yes, I think she might reconnect soon. And I think while we wait, perhaps I have one question from the floor, which has to do with the presentation of Alessandro, I would say. The question is, how does one deal with interest rates on convertible instruments? Should price on conversion be taken into account for determination of the interest rates? Perhaps,
well,
Alessandro, you start.
Yeah. I can take that if you want, Alessandro.
Yeah, struggling to imagine in an intercompany a convertible, but no, of course, if you have if you have a view on it.
Well, we deal with these issues when these securities are transferred intercompany.
Okay.
In normally trading activities in financial services, typically options are segregated and priced separately. There are market standards pricing models for options, and once you take all the equity component out of an instrument, it's a typical. It could be subordinated or senior debt, and then you can benchmark and analyze that. So there is a sort of the derivative component which can be priced separately, and most databases, Bloomberg, Reuters, in particular Bloomberg, provides tools for pricing those options.
Thank you. I'm sure we have made the audience happy with that. So this being said, I think we can go back to Andrea. I think she managed to get back to us, and so the floor is yours.
Thank you, Professor. Yeah, sorry, my Zoom kicked me off right at the wrong moment. So, we're going to finish today with a little session on cash pooling. I love cash pooling because it's something that we all do. I think it's a deceptively simple transaction. It's sort of intuitive. It makes sense. It sounds like good housekeeping. You're sweeping up your extra cash. You're borrowing at short notice. It's almost like the jar of spare change I have by my front door, except it's billions of dollars instead of a few francs. So, and of course, it's nuanced and the scale is huge. So, so that's why this is an issue. So, I mean, the economic benefits are obvious. It gives you the benefits of managing the liquidity within your group. Hopefully it gives you an enhanced return by being able to manage your cash on in a bigger scale rather than just bit by bit, and hopefully it reduces your financing costs as well, because you're not having to pay the bank every time you go for a borrowing. That is the concept. And for our company, for example, in reinsurance, it's more than just a convenience. necessity that we're able to pay very large claims at very short notice. And that's part of our regulation, is that we're able to do that. So it's not just a convenience. So just as we pool our risk centrally, we also have to pool our cash centrally to make those payments. So what's the status of cash pooling? How to analyze a cash pool has been a topic for many years, and there was no explicit guidance before on this. So one of the outputs of the BEPS project, as we've talked about today several times, was to provide more detailed guidance on all the financial transactions, including cash pooling. And I think it's fair to say that this is a simplified approach, although as my colleagues were saying earlier, there is some welcome nuance in the guidance here. And the guidance covers the topics mainly of what is the role of the treasury function, which is a key question. What's the pool leader doing? And number two is, how do you share the benefits from this, assuming that there are any? And also, what do you do about guarantee fees? So we'll come back to these in a minute. And as with many of you, we've brought our own policies and practices up to date following the recent guidance. And it's been quite an interesting look at how it operates in practice. It's something that it goes every day. It's something that Treasury is well used to doing. So so it's a good chance to really look again at exactly what's happening on the ground. So what's the problem with cash pooling? If you go to the next slide, we can talk about some of the issues. Thank you. So number one issue is that no independent parties do this. So you need to break it into pieces in order to find benchmarking and in order to analyze it. So you can look at kind of the easy pieces, which is looking at the interest rates for the borrowers and the lenders. You can look at the reward for the cash pool manager. There's harder ones on here, like looking at the level of the borrowing and also how do you share the benefit. There's not a whole lot of data on these topics or benchmarking. So in this case, you have to really rely on doing your analysis. And you need to look at the big picture and find out what's actually going on. So you need to look at the economic characteristics. And what we've been doing is we look at the balances and we ask ourselves, are there some parties that are always a net borrower or a net lender? We look at how large are the balances. That was something that was sort of a surprise to me, how large the balances actually were in our cash pool. And how does this fit with the other funding in your group? So can it even be considered a long-term loan if the party is always in a borrowing position, or even worse, sort of equity funding if you permanently have a loan from the cash pool? So those are all really important questions that change the economics of this, and they're important to get to the bottom of. Another challenge that we have at the moment are the low interest rates. So, I mean, the OECD guidance, and probably most people assume that there is going to be a benefit to share from cash pooling. But this is really becoming more and more of an issue. So I put on here the central bank rates. You can even see in the last 2 years how much some of them have moved down. And if you look at the last, longer period, it's really noticeable that there's not a lot of interest coming from these things. So there's also, because you're able to manage this on a slightly longer term basis than, say overnight lending, you can hopefully generate some investment income from some of this money, but you can't, you're constrained, especially in a regulated group like ours, because you always have to make sure that you've got sufficient liquidity that you could pay out at the drop of a hat in many places around the world. So that's not that's for us, that's not such a huge benefit. So and then you have to ask the question of, well, what if we have a negative interest rate in practice? So far, we've used a floor of 0 so that people aren't actually losing money in the cash pool. But how long is that supportable? It depends on what happens with interest rates. But you can imagine a scenario where that's not going to work anymore. So I think some of my colleagues can comment on that later. But and then also, if the group is absorbing the negative interest rates, is that some kind of group support that should be somehow taken account of? And that's, thinking about how that should be characterized is also important. So that's a lot of questions to ask about something that's quite simple. What do you do once you've asked all these questions and you've got your answers? I mean, just from a practical point of view, one thing we've been doing is doing our FAR analysis and looking at it piece by piece. So, because each one of these steps of the cash pooling process have very different profiles and especially risks, which is something that often gets kind of overlooked in a FAR analysis. So that is something that's really important to consider: who's actually taking the risks here, and how significant are those. So as we go through that, we also need to think about the options realistically available at each stage. And that's been mentioned before in this session, but it's really important to keep in mind what are the benefits of this cash pooling. So it's not only the enhanced return that we were mentioning before, but also just simply having the access to the instant cash without needing to go to the external bank, without needing to worry about not being able to sell some assets to raise the cash. So those are extremely important to think about and analyze and think how does that fit in with what are your options realistically available. So you need to bring all of that together and then document it. So as I mentioned before, this has been a big exercise in us documenting these further considerations. So the benefit of the OECD guidance is that it is more nuanced. The part for us is mean that we need to spend a lot more time up front now analyzing these questions and making sure that we have the answers, and that not only that we have the answers, but that our transfer pricing policies reflect the answers that we have, which is sometimes overlooked. So that's kind of been our experience on the cash pooling, and it's been a great chance to get to know some of the cash pooling people who I'd left alone for far too long. So thanks. I'll hand that over to my colleagues for further comments.
Yes, indeed. Thank you. I think it's a very good overview of your in-house policy on cash pooling, and I'm sure that the other panelists have comments. So Antonio, you may like to start?
Yeah, so Andrea, thanks a lot for this outline. I recognize everything you were saying, and maybe I start from one critical point, which is of course impactful on all other areas of intercompany financing and transfer pricing, which is the correct characterization of the cash pool leader. So what is the function or the aggregate of functions that the cash pool leader is performing? And if we go back to recharacterization, a topic that we have addressed at the very beginning of this conversation, oftentimes in the past, what you could observe is that other financing transactions, intercompany financing transactions or functions were bolted onto a basic cash pool setup. So this was often the case in the past, where less sophistication was present on the side of the tax authorities, and then you could build, because cash was concentrated in one place, around a cash pooling function, other transactions, but without giving proper regard to what is the function that is performed. Do we have a real treasury? Do we have a real profit center there? Or is it more a transactional center, or a cost center, or a service center, as a matter of fact, which is often the case when we look at cash pool proper. Now, starting from that consideration, you were also mentioning novelties in the guidance. Clearly, attempts were made in the past to glean from guidance that wasn't developed for cash pool proper, but was developed for other phenomena of a synergistic nature. I think of procurement as a function, and how the OECD was giving guidance on how to allocate the benefits of procurement. I think what we read now in the guidance is consistent with that, where in fact all participants, including the cash pool leaders, should benefit and should participate in the benefits. But I mean, if you have a cash pool profiled as a service center or as a pure cost center, obviously that cannot be a portion of the bid-ask spread, but rather should be priced as a service and then contribute to the total cost of the structure. And the bid-ask spread should be divided between the participants, which means that not only the lenders, not only the ones that have net positive cash balances, but also the ones that have net borrowings should participate in the benefits. So that to me, I think, is consistent with the general notion of the Amsterdam principle and the fact that this is a co-interessence of all the members, and they do that for mutual benefits. So the needs of cash create the demand, which in turn creates an advantage for the ones that are in excess cash position. So having said that, I think there are indeed some issues. And before we address a couple of these issues, I just wanted to remind that everyone that cash pools can be structured as target balance cash pools, where you have actual sweeps of funds, or virtual or notional cash pools, where actually there are no sweeps of funding, but it's a notional aggregation or a virtual aggregation of the positions. But then finally, there are other products in the market these days. Some financial institutions are offering so-called virtual cash pools. And what I mean by that is that one single bank account is used instead of different bank accounts in the different jurisdictions. A single bank account is used by all the participants. So that concept as a service offered by financial institutions is also evolving. And I think we will have to see what the consequences will be in terms of how it is maintained and managed at the level of corporations. On some of the issues, I think a striking one is indeed negative interest rates and how to approach negative interest rates. Another one is the fluctuation of positions in the cash pool, and the typical challenge that you see being raised by taxing authorities is when you have permanent positions and excess cash deposited for a long period of time, challenging the nature of that transaction. So one thing that we typically do, as you also pointed to, Andrea, is monitoring the positions on a frequent basis, making sure that the pricing is dynamic pricing, because if you use thresholds, so you have a deposit in excess of, say, 6 months or 12 months, then the pricing of that deposit should change. You cannot use anymore an overnight deposit rate, or you cannot use a short-term interest rate. So that is an important aspect. I feel that is the most common challenge that we see on the side of taxing authorities when you have long-term deposits. The Swiss tax authorities are notoriously looking into this type of situations. When we look at negative interest rates, my experience is that in the vast majority of cases, indeed, is defaulting to zero. So that indeed you don't create an issue, but the reality is that I don't think that is going to be lasting too long. Also because from a commercial standpoint, we do see some of our clients being offered by financial institutions, especially on commercial lending, money at the negative interest rates. And that means that it's not, to me, sustainable over the long term to default to zero. So other types of solutions might need to be found there. So these were my initial comments, considering that we still have 15 minutes and other people to comment. Maybe Guglielmo, I stop here.
Thank you, Antonio. Before we move on to Antonio Fortunato and Alessandro, perhaps you have replied indeed just right now to one question from the audience, but I shall repeat it just to see if I understood correctly. It says, will you set a negative interest rate to cash pool participant that deposits into the pool, namely creditor? What you, I believe you took the view, but if you can reply precisely to the question.
Yeah, so as I was saying, and as also Andrea was pointing out, the best practice today is to set the rates zero, so to default to zero. But to be fair, in a protracted negative interest rate environment, I think that position probably will have to be challenged. At the same time, if we think about situations where you have a cash pool leader that is a pure service provider, you know that once you have set your basic returns, and in the example that Andrea was making, you can play with the bid-ask spread, and you say, I set interest rates at market rates. So I set negative interest rates and I set positive interest rates. And then at the end of the year, you redistribute the cash pool advantage. You calculate the cash pool advantage and redistribute it to the participants, because as we were commenting, this is a synergistic play. And if the cash pool leader is a pure service provider, what you could do, you set a basic return for the cash pool leader, which could be a cost plus as an example, and the residual is spread between the borrowers and the lenders. Then the negative interest rates are washed out in that step, because then you determine the net and then you allocate the net. Then the question is, how do you allocate the net? And in my view, again, both borrowers and lenders should participate in the benefit, maybe in different proportions, but they should participate in the benefits. So at the end of the day, it may be just an optical issue. The interest rate that is set for the maintenance of the cash pool when you have recurring transactions could be a negative, but then what you need to measure is the overall impact once you have redistributed the cash pool advantage. So how are participants? Are they better off than in fact accessing the market and depositing in the market, or are they better off when depositing internally? So that to me is the real test, not necessarily when you set the interest rates, because that would maybe distortive of what the reality is in a specific setting where a cash pool leader is a pure service provider. Different would be when you have, in fact, a cash pool leader operates as a profit center, takes on risks, assumes risk. And again, an additional point on guarantees. Cash pool structures typically are supported by cross guarantees. So all cash pool participants guarantee each other. And so that reinforces my point on, you can only say whether the result is at arm's length once you have looked at the outcome at the end of the year, once you have established the cash pool advantage and reallocated it.
Thank you. So I believe that before asking Andrea to comment or reply to these comments, I would ask Alessandro and Anton Fortunato to make their comments.
If I have the time, I have a quick one. In those structures that are recast based on Chapter 10 guidance as concerted action, so in which the pool leader does not factually manage risks and does not have the capacity of managing those risks, is there perhaps a leaner requirement of each participant of justifying its debt capacity? So if I'm accessing a cash pooling that characterizes as a concerted action, is there still a requirement for me to show the capacity of bearing, for example, a negative balance, so being in a debt position towards the cash pool to that extent for that amount? That's the first question, because of course, I think the capacity is a requirement that the OECD poses both for the recognition of a transaction and for the actual pricing of that. But since the pricing, it should not be an issue in a concerted action, but more the sharing of the benefits. I was wondering whether you are of the view that there's a leaner approach towards analyzing the capacity. And a second point is that in allocating the benefits of a cash pool, do you think that there is still a requirement to analyze statistically the balance of my deposits and therefore apply some behavioralization of my deposits and assess whether I'm actually depositing or withdrawing on a long term on some of the amounts or short term? Does it make really a difference? Should it make a difference for allocating the benefits of the cash pooling?
Andrea, you want to reply?
I mean, I think on your last question, Fortunato, that I think you could, I mean, you could argue that you're getting the right economic result, either, you know, whether it's long-term or short-term, but I think you'd be missing some important analysis there.
Well, I think your case most likely is that not of a concerted action in an insurance environment. Most likely, the cash pool leader is acting as a trader fully.
Course,
so it was more in relation to experience that maybe Antonio and Alessandra have in other industries.
Maybe Antonio Fortunato, to this question in particular, ideally, yes. So to respond directly, should we look at behaviors? Yes, ideally, yes. However, that might be complex and may be difficult to glean from simply positions in the cash pool as to the intents. But I think the point is, what do you use cash pool for? That to me is the fundamental question. And that goes also in answering maybe your first question, which is capital structure. If I use cash pool for working capital financing short term, then yes, there is an impact on capital structure. And maybe we should be looking at that in also answering the point of what you can afford in terms of borrowing from the cash pool. But fundamentally, if you're using cash pool to fund CapEx, then you have a problem.
I don't know if Alessandro, you want to have a comment and perhaps also make reference to any departure in terms of policy in your cash pooling methodology. If you have anything to raise as a point there.
Oh, I'd really like to go back again to the topics of negative rates, which is really an hot topic, and now it's there from some time because it's nothing particularly new, and so in our case, our Treasury Center is the cash pool leader and is also in general a profit center. So looking at the realistic alternatives, the Treasury Center is able, and it goes to the market with commercial paper, for example, which are in this moment are negative rates. So we are really looking at this point of maintaining zero cap on negative positions. We are really let's say looking at start charging negative rates on deposit, because it's really difficult as you said before, in the long term to maintain this position. Now, if you can go to the market and you have this alternative, you issue a commercial paper and you have a negative rates, you're struggling now to defend zero balance, cap at zero.
Because to keep it at zero, how do you draw the line? Because I think that almost all of you said that for the moment, we stay on a zero. And but we acknowledge we have to change at some point. Yes, but when? So if where do you draw the conceptually? I know that any move is risky, so everyone believes and hopes that the situation may change. It's more or less like the COVID-19, I think.
Yeah.
And, but this temporary situation continues, and. So my question to all of you is, how do you draw the line? Namely, is a more a practical attitude that when you make changes, they must be possibly permanent changes, or you have a more technical, let's say, argument compared to other situations on transfer pricing, where anytime there is a market change, you do go along and change your position?
Well, I mean, I use the smoking gun test, Guglielmo, which is if you have an internal comparable, and commercial paper programs, as Alessandro was saying, are the prime example. And I have a few clients that have commercial paper programs at negative rates. So at that point, I think you have a very strong justification to say to the depositors in your structure, guys, this is the reality. Let's not go around it. This is the reality. But again, it depends on the facts, circumstances. But to me, the fundamental point which I insist on is if you have a cash pool structure which is fundamentally with a leader as a cost center, the test is not necessarily on the running rates. The test is on the outcome when you have distributed the advantage. So the negative rates may be simply going back to what Anton Fortunato was saying, to drive behaviors and make sure that the behaviors are set correctly. So not over usage of facilities that are not there for the purpose of financing investments in capital. And then if you have behaviors right, then you can be comfortable that the outcome should be also correct. But as I said, mine is a smoking gun test.
Well, this test I do like very much, and I would like to add something on top of that. Clearly, that many times, Alessandro, a potential issue comes from local comparables. So let's say that there's a bank offering a 0 rate or maybe even slightly positive rate. There's a way to support the view that that is potentially a non-comparable transaction. It is indeed available, but the banks are building a very large short-term deposit-taking platform in order to transform some of that into longer-term funding. So for them, some of that somehow is longer-term funding. For you, it isn't, because you don't apply statistical method. It's not so big to become something which potentially creates a capacity of longer-term financing. So there is a way of claiming that, but indeed, it's a possibility for them to go next in an office, in front of your office, to the bank and have access to that. So it does create risk.
Well, so to answer to your question, Guglielmo, when is the time? I think the time is coming, because now we see also looking at the long-term policies that from the central banks. Now we were waiting and to look and see if now the general macroeconomic environment were changing or not. Now it's let's say several years, or also the outlook seems the one that we are not, say, moving from this environment for a while. So probably is the time.
Thank you, and I believe we are precisely at the end. 90 minutes it was, and 90 minutes it is. So I really enjoyed the panel. I hope the audience did too. And so with the 0 rate, we end our debate, which we may take somewhat later at the next conference. And I give the floor back to Vikram Chand.
Thank you, Professor, for this excellent panel. I really enjoyed listening to all the interventions of the speakers from the consulting world as well as from the industry. Fantastic presentations by everyone. So really thanks a lot to you, Professor Maisto, for chairing the panel, and to all the speakers for their wonderful interventions.